Hi, everyone. Welcome to the Christian Employers Benefits Podcast brought to you by Imago Day Insurance Advisors. So, today I wanted to talk to you a little bit about what goes into an insurance plan. So, when you're thinking about insurance, how does it actually break up? Well, every insurance plan has three component pieces. The question is whether those pieces are all bundled together or they're unbundled, and you can kind of pick and choose through those pieces. But every piece has at least, number one, an admin cost. So there's a cost to offer insurance. You're going to have to pay someone to help you do the legal filings and the paperwork. They're going to help you with all the claims information. They're going to help pay for care for your people. There's an administrative cost that comes with having a health insurance plan. The second piece of this is what we would call stop loss. So stop loss is the actual insurance that you're purchasing. It's a way for you to manage risk. So you are purchasing something that gives you a backstop in which claims are. So say you have a catastrophic claim of $1 million. Well, your small business may not be able to pay $1 million to go ahead and cover the cost of that claim. So you pay for what is called stop loss insurance. The stop loss insurance says that up to X amount this way, so X amounts over the course of the year, you're going to go ahead and only have to pay this much, and then the insurance will take over. Well, you also have insurance this way. So say an individual person buys something or has some claim happen, and that individual claim is $100,000. Well, you may not be able to pay $100,000 for that individual claim. So over X amount, the insurance will cover the cost. So that's the second piece that you're paying for. So you're paying for an administrative cost is one bucket. You're paying for the actual stop loss, the actual insurance that protects you is one bucket. And the last bucket is called a claims account. So number 3 is a claims account. And what that is you as an employer set aside money each month into we'll call it a savings account. You're putting money into an account to go ahead and pay for potential claims that may come up. And you will put money aside each and every month for that. And as claims do arise, they will pay out of that claims account. Now, the way that these three pieces fit together changes upon what type of insurance plan you're on. So I've used this term in the past, the BUCA plans, your major fully insured plans. This is your Blue Cross, United, Cigna, Aetna. So these major carriers, they're what are called fully insured. They are grouping together all three of these pieces. We could also call them bundled. So you are paying one price per month that bundles all three of these pieces together. Whatever you do in regards to claims doesn't affect this price. So if you used it a bunch or you used it not at all, it's not really going to affect your pricing. It doesn't change. It will go up each year whether you use it or not. That's kind of how the system's baked because you're just pooling yourself together with everybody else. The other side of the house is called what we would call self-funded. Now, on the self-funded side, you could also consider that as unbundled. So an unbundled plan means that those three component pieces are potentially run by different entities, different companies. So you are able to partner with different companies for each one of those pieces to get the best plan. And instead of one price, one premium cost that just covers any and all situations regardless of the employee, this one is unbundled. So it means that you do directly fund a claims account. Now, the benefit of this is if you have a good claims year, so your employees are relatively healthy, there was nothing that really major happened, and you actually didn't use all the money that was in your claims account, you would get a refund back. So they would refund you the unused portions of that insurance cost of the claims account. This gives you the opportunity to actually affect what happens for your employees and in your business. So in the first situation, a bundled situation, it's all put together. So it doesn't really matter what you do. There's no really way to help anything. In the second way, because you have a claims account that you're managing, you have a claims account that you're trying to protect, everything actually now begins to matter. So going to a hospital that's going to do a surgery that's $20,000 versus another equally good hospital next door that's only going to charge $5,000 is going to make a big difference to your claims account. right? One of them's a $15,000 savings just by going to a different hospital. Same with pharmacy. So a pharmacy benefit manager makes a tremendous impact on what you do. If you have a pharmacy benefit manager who is going to be able to save you money, that's not trying to make the biggest profit in the world off of you, but actually looking to save you money, where they can get you better drug costs somewhere else and save you some money, that's going to make an impact to your claims account. So all of these things matter, including wellness. So if you're going to add a wellness program, a healthier group of people for your business is actually going to end up saving you money, because they're not sick. They're not chronically sick. They're not always at the doctor. They're healthy and they're thriving and they're doing well. So all of these pieces come into play for a holistic approach to being able to help your employees navigate this complex system. So those are kind of the two breakups. The final one we would call level funding. Level funding is a form of self-funding. The only difference is you would pay single payment each month that looks like a bundled plan. So you would be given up front, this is, you're paying, this amount of money every month, and it doesn't change regardless of what happens with the claims. That's how they're leveling it out. That helps an employer who needs to control their monthly costs to be able to do something that is self-funded without the volatility that comes with self-funded. So level funded is a way for you to go ahead and basically get the best of both worlds, all the benefits of a self-funded plan, yet the monthly financial stability and being able to manage your cash flow from month to month as opposed to self-funded. So those are the differences. Those are how we are to think of a plan. So each and every one of you who has an insurance plan falls into one of these categories. If you are unsure, if you want to go ahead and learn more about that, please reach out to me. I'm happy to answer any questions that you have. Thank you.